right, so the focus of today's presentation is legal aspects of raising financing. And just a little bit about myself. So I've been a serial entrepreneur. I've co-founded several companies. I've also a venture partner in Urbanus, which is a seed stage venture capital fund. And as Rachel mentioned, I chair Next, which is a new model for delivering legal services to startup and emerging growth companies. We have created fixed price packages for over 75 different packages and service bundles that are delivered by senior attorneys in a hands-on, high-touch approach. And we've partnered with leading technology providers like NASDAQ, Boardvantage, and Carta and UShare to create a very collaborative, transparent, and efficient client-centric model for delivering legal services. So we're going to start today talking about the term sheet. So a term sheet is usually the first document that you're going to be involved in preparing and negotiating, and it highlights the key terms of the transaction. And so I often get asked, is it helpful to actually put a term sheet in place? And the answer is yes. For number one, it flushes out the key deal terms early on, and it forces you to discover early in the process if there are going to be any deal breakers between you and the investors that you're talking to. It also makes it easier when you get to drafting the definitive documents to draft those documents. So while it takes a little bit of extra time up front, it's very important and saves a lot of time in reducing overall time in completing a deal. And another thing that it does is it makes it harder for parties to change their positions later. So if you've reached terms with an investor, for instance, and a deal term changes later, you can point back to the term sheet and explain that this was already negotiated and agreed to earlier on in the process. The term sheets themselves are generally non-binding, but they can include some binding provisions like confidentiality and exclusivity period, governing law, and fees. So once you have a term sheet, you're going to see on that term sheet different securities depending on what term sheet you're negotiating. And so the different forms of securities include common stock, which could be voting or non-voting. And this is what founders are usually issued when forming the company. Then you have preferred stock, and the preferred stock is Series Seed or AA, Series A, B, C. So you may have heard of people talking about different types of preferred stock. The preferred stock has rights and preferences that are superior to the common stock. And we'll talk about some of those a little later in the presentation. And they also have protective provisions over the common stock. And we'll talk about those a little bit later. And so when you're working and negotiating with investors who are investing in a priced equity round, what you're usually going to be negotiating about is the rights and preferences and protective provisions and other clauses tied to preferred stock. We're going to then talk today about convertible notes. We're going to talk about safes, and we're going to talk about warrants. And what we'll do as well is at the end of the presentation, I will put my contact information in the chat box, and anyone who emails us, we're happy to share a copy of this presentation. So just in terms of taking notes, anyone who would like a copy can get a copy. In terms of the convertible notes, a lot of you who are going out and raising rounds of initial seed capital may come across the convertible note structure. This is debt instrument with interest that usually accrues, meaning you're not paying it along the way. And it bypasses the need for negotiating a current and agreeing upon a current valuation. So when you start off, you've got the entrepreneur, and as an entrepreneur, you see all of the upside potential of your company. You've got the investor who sees all the risk. They see the execution risk and the market risk and the technology risk and the capital risk. How do two groups looking at things so differently come to agreement when something is just an idea, or maybe it's an idea and a minimum viable product? How do you come to agreement on what the current valuation is for that business? And so sometimes you'll bypass that. You will put a cap in place, which we'll talk about, which has some tied to valuation, but isn't your valuation today. So the key terms that you're going to negotiate are the interest rate, which, as we said, is usually accrued and added to the principal on conversion. The term of the note, so often you'll see a maturity date, 18 months to 3 years, a discount rate, a very common discount rate in terms of market discount rates that you see a lot of 20%. And you have a cap, and we're going to go into the cap, which is the maximum amount that the investor will convert at when you do a priced round. They either going to get the benefit of converting at the cap, or if they get a better conversion price converting at the discount, they'll convert at the discount. These are usually unsecured, but they could be secured as well. And the convertible note converts into the company stock automatically when you have a qualified financing. It could also be a voluntary conversion if you have a priced round that doesn't meet the qualified financing trigger amount. If you sell the company, people could get their money back or convert and deem to be convert and participate in that sale. Or you can have conversion usually at the demand of the holder, of the investor, at maturity if the note hasn't already converted or there hasn't been a corporate transaction. And you have priority over the common and the preferred shareholders during the period of time that the note is outstanding. So now let's just talk, because it's such an important concept, about the cap. And you may have heard investors or other entrepreneurs talking about doing a convertible note with the cap. So a cap, as I mentioned, is a value that it's not the current value of the business today. It's a value that when you do a priced round in the future, that the investor is going to convert at either that valuation or again at a discount. So let's just use this example. A company with 1 million shares of common stock outstanding issued a $500,000 convertible note with a conversion discount of 20% and a valuation cap of $5 million. The company is executing really well, and they're able to raise capital at a pre-money valuation of $10 million in the next round of financing. So for the new investors who come in that priced round, 10 million valuation, 1 million shares outstanding, you divide the valuation by the shares to get the share price, so it's $10 a share. They're investing 500,000. In essence, they're converting 500,000. There would be some interest on this as well, but for purposes of the example, we're not going to include the small amount of interest. So 500,000 is what's converting at $10, 50,000 shares in your company. If they use the 20% discount, 20% discount of the 10 million is 8 million. So it's $8 a share. They're going to get 62,500 shares in your company for their $500,000. But at the cap, if you capped it at 5 million and your valuation in your next round was 10 million, it's $5 a share, and they're getting 100,000 shares. So you see, the cap is really important to at least understand what the potential impact could be of the cap. Here you see that same $500,000 investment got new investors 50,000 shares. At the discount, it would have got you 62,500 shares in your company, the investor, and at the cap, it got them 100,000 shares. Really important to understand the cap concept. Now we're going to talk about another instrument that's gaining in popularity. It was very popular on the West Coast, but we're starting to see a lot of deals at Next now. We're working with a lot of the clients that are raising seed rounds. Even on the East Coast now, we're using safes for these financings. So what are the key terms in a safe? You have the discount rates and the cap, which again are the same as in a convertible note. But unlike a convertible note, you don't have an interest rate or maturity date. And this is a big deal for you as the entrepreneur. And why? As an entrepreneur, if you can do a safe, this is your first choice. Security is going to be a safe, because In a convertible note, if you get to maturity date and you haven't raised another round of funding, you're going to need to either pay the money back that you raised in the convertible note, or usually the investor will either choose to get their money back, or they will demand, or they'll agree to convert. And if you don't have the money, if you raised $1 million in a convertible note, and it comes to 2 years from now and you're not sitting on $1 million in free cash, you've been busy building the company and it just is taking a little longer and it's been a little harder and you haven't quite hit all the milestones as fast as you hoped, but you're not sitting on $1 million to repay that convertible note. So it creates you often are then forced to have to go back to the investor and renegotiate if you don't have the ability to pay it back. So a SAFE eliminates all of that in terms of what happens at maturity. And that's kind of why it's very popular for and very favorable to founders. So it converts like a convertible note. It converts in the next equity financing at a discount rate, which we've spoken about, and a cap. Or if you sell the company before the SAFE, they either receive a multiple of the investment, or they can convert at the cap and participate. You're not a stockholder until conversion. So a SAFE does not give you voting rights or rights. You're not treated as an equity holder. And it can be set up as well to have priority over common and preferred stockholders. And then finally, we'll touch on something that you've probably heard talked about is a warrant. A warrant is a derivative that confers the right but not the obligation. And it's normally for equity securities like common stock, where you may issue somebody a warrant to purchase 50,000 shares at an exercise price, maybe $2 a share, which is the fair market value today. You keep the warrant open for a term, for example, of 5 years. And so at any point over the next 5 years, as your share price goes up, if it's hopefully going up, the warrant holder can exercise their warrant for $2 and get shares maybe worth $10. And it's often offered as additional incentive to an investor for moving first or moving quickly in a round, or to a strategic partner tied to a strategic transaction. Those are two common places that you'll find that showing up. All right, so now we've kind of covered the term sheet. We've covered some of the different types of securities that would show up. Now we're going to get into you as the entrepreneur are getting ready to negotiate with investors for a round of financing. And there are really three levers, three main areas of negotiating. One is the value of the company, and this drives the percent of the company you're selling in the financing. So a price round in an equity financing, for instance, or you would be negotiating the cap in a convertible note or a SAFE. If it's a priced round, you're also going to be negotiating rights and preferences. And these rights and preferences drive the investor's preference with respect to distributions of profit or upon a liquidity event. And also things like the investor's rights to maintain their ownership level when you issue new securities. And then you have investor protections or the control provisions. And this is where the investor who's normally going to be owning less than 50% of the company, so that have a minority interest in the business, has more control, even though they may only own 10 or 15 or 20%, through these investor protections or control provisions. And we'll talk about what some of those are. Now, I found that in many interactions with entrepreneurs, between these three areas of focus, they're focusing mainly on valuation. You know, what's the valuation? How much of my company am I giving up? But actually, the investor rights and preferences and investor protections can have a much bigger long-term impact on what it's like to build and grow your company and what you get at the end of it, than even the valuation, which may be a few percentage points difference in valuation. If you have a very big exit, is not going to impact your life materially one way or another. but these investor rights and preferences and investor control provisions or investor protections, where investors spend a lot of their time and their lawyers spend a lot of their time focusing, are much more important. And so that's what we're going to be spending the next part of today's session talking about, these three areas or levers of negotiation. So on the value of the company, there are two important concepts to know as an entrepreneur when you're dealing with valuation. One is, what is the difference between pre-money and post-money valuation? And the second is, what does it mean to say, this is the value of my company on a fully diluted basis? The pre-money valuation is the valuation of the company, not including the new cash that's about to be raised. The post-money valuation is the valuation of the company, including the new cash that was raised. So here's an example. You have an entrepreneur who's raising $500,000. And I've seen this type of scenario. The entrepreneur and the investor agree on a valuation of $2 million. I get a call from the entrepreneur, very excited. They have agreed to a $2 million valuation with the investor. And I ask, is it pre-money or post-money? And they don't know. They never asked. The investor, if the investor believes that it's, the entrepreneur is thinking it's pre-money. So in a pre-money scenario, the business is worth $2.5 million after the closing, and the investor is going to receive 20% of your company for their $500,000 investment. The investor might have been thinking it was post-money, so the business was only worth $1.5 million before they put their $500 in. And so they're getting, actually for that $500,000 investment, they believe they were getting 25% of your company. So the same $2 million valuation, the same $500,000 investment, but whether it's pre-money or post-money is the difference between whether you just agreed to sell 20% of your business or 25% of your business. So you can see that's really important to make sure you understand when you're negotiating valuation, which one of those you're talking about. Fully diluted basis is another really important concept. When you calculate a share price, you divide the value of the company by the number of shares. But the question is, what is included in that number of shares? Is it just what's issued and outstanding? Does it include stock options that are set aside in an equity incentive plan but not yet granted? Does it include warrants? We spoke about warrants earlier that are issued but haven't been exercised, so they're not shares yet. So when an investor says that we're going to value your business at a certain valuation on a fully diluted basis and calculate the share price on a fully diluted basis, they saying A, B, and C, all of those are included. They do not want to be diluted later when stock options get exercised or granted and exercised, and when warrants get exercised. They want all of that built in up front so that they do not run the risk of any dilution from any of those. And so you've got to assume that an investor is almost always going to require and assume that the share price is being calculated on a fully diluted basis. So let's give an example. You have 2 million shares issued and outstanding, meaning you've actually sold shares and you have share certificates issued for 2 million. The stock option plan had 500,000 shares, some of which are granted and some of which are not, and some of the ones that are granted have not been exercised. The investor is investing $500,000 at a pre-money valuation of 2 million. So we said to get the share price, you divide 2 million by the number of shares. So if you only base it on the shares issued and outstanding, that's 2 million shares. $1 a share. So the number of shares issued in the financing that you're selling for that $500,000 is 500,000 shares. You've just sold 500,000 shares in your company. But if the investor was calculating this on a fully diluted basis, you divide 2 million the valuation that you agreed on by 2.5 million. So it's 80 cents a share. The investor, therefore, is getting 500,000 divided by 80 cents a share, or 625,000 shares, right? Really important. Same amount being invested, $500,000. Same valuation, right? We talked about the valuation being 2 million. Yet in one instance, it's 500,000 shares. In the other, it's 625,000 shares. Really important. And you always want to, when you're negotiating your valuation as an entrepreneur, you want to do the calculation internally on a fully diluted basis. All right, now we're going to go to rights and preferences. So these are some of the more common rights and preferences that are going to be negotiated by investors when you're negotiating with them. And the ones in red are the ones we'll talk about in a little bit more detail. But there's liquidation preferences, which could be participating and non-participating. There's preemptive rights, there's information rights, there's drag-along rights, there's anti-dilution rights, there's dividend rights. There's rights of first refusal and co-sale. There's redemption rights. There's registration rights. There's board seats. So while you may be coming in to get ready to negotiate in a priced round with an investor thinking about valuation, valuation is just one piece of what they're thinking about. They're thinking about all of these different rights. And as an entrepreneur, you need to understand and have good representation in those negotiations around what all these different rights do. So the liquidation preference is a mechanism where the investor gets their original investment back or some multiple, plus any declared and unpaid dividends before there are any distributions to the common stockholders. So a one-times if somebody invests $1 million with a one-times liquidation preference, they get $1 million before the common shareholders get their first dollar. If it's a two-times liquidation preference, $2 million before the investors, to the investor before the common shareholders get their first dollar. And it's, you really should be pushing for one-times liquidation preference, but sometimes you'll get a term sheet that may have a higher liquidation preference, and that's something you want to negotiate over. Now, those liquidation preferences can either be participating or non-participating. If it's non-participating, what the investor is getting is they either getting their liquidation preference, so their money back, or they can convert or be deemed to convert to common stock and share in the proceeds of the sale of the company when it's sold. So if an investor owns 20% of the company, they get 20% of the proceeds upon the distribution and sale of the company. But the key here is the box that talks about or. They either get, whichever one is better for them, they either get door number 1 or they get door number 2. That's non-participating preferred, whichever works out better for them. Participating preferred, the investor comes back and says, you know what, I want both doors. First, I want to walk through door number 1 and get my money back. Then I want to go through door number 2 and participate with the common stockholders and share in the proceeds of the sale of the company, for instance. So it's a very, one-word difference in a term sheet, participating versus non-participating, and it can have a huge impact because also what your first round of investors get, your next round of investors are going to say precedent is set, and they're going to look for the same thing. So if you give participating preferred to when you raise $3 million in your first priced round, then when you get to your Series A round and you're raising just say 10 million, they going to look at that and ask for the same thing. Now you've got $13 million that first goes through door 1 before they still get to go through door 2. And then if you do a $20 million round, now you've got $33 million doing that. So really important concept to understand. Preemptive rights is a common one that investors will ask for. This protects them when you do future rounds from being diluted in those future rounds. And what it basically says is that if it gives them the right, based on what they own currently in the company, to purchase that percentage of the next round to keep their position at the same percentage. So if the investor owns 20% of the company before a future financing, they have the right to take 20% of that future financing, which will keep them at 20%. One thing you need to understand as an entrepreneur is just the impact on future rounds. So if you give everybody preemptive rights and you have a future investor who says, I'll do this next round, I'll put in 10 million, but I want to put in the whole 10 million, or I want to be able to put in 80% or 90% of it, and you have 30% of the company that have preemptive rights, you have a problem, because if everyone wants to exercise their preemptive rights, you can't meet the demand of the new investor. And so you have to go back to your old investors to get waivers from those preemptive rights, and that delays, and you don't know if you'll get the waivers. And so sometimes you'll see this concept around preemptive rights of a major investor where you just limit the preemptive rights to investors who've invested a large amount in your company, let's just say $250,000. All right, next we have information rights. So information rights are the right to, as an investor, to financial information in the company. And as an entrepreneur, your early investors are your partners in building the company. You should be spending a lot of time getting to know them and doing due diligence on them as they're doing due diligence on you. You're really in this together. And so you want to, and it's helpful to keep your investors really informed as to the progress of the company as you're building and growing the company, particularly if you hit a rough spot and you need to go back to your investors to help bridge you through. You don't want that to be the first conversation and information you've shared with them in a year is that you're run out of money. However, when you're negotiating those information rights, there's a range of what it means to be able to provide your investor with information. It could be audited or unaudited. For early stage companies, it's usually, it's almost always unaudited. But at some point when you hit a certain revenue target, it may call for them to become audited financial statements. It could be delivered on an annual basis. So income statements, balance sheet, cash flow statements on an annual basis. Could be that you're required to deliver it on a quarterly basis. It could be that you're required to deliver it on a monthly basis. So what you're negotiating is not so much whether you should provide information or not, but how frequent and also how detailed. In addition to the standard financial information, are you being required to do end of year budgets, key financial metrics? And so what you're weighing as an entrepreneur is the benefits to keep the investor informed, which we've said is important, against the burden on the management to produce information. And sometimes this also, the more extensive information may be limited to what are called these major investors, with the less kind of frequent, less in-depth information, but important information still being delivered to non-major investors. Another important right that's going to show up in the documents are drag-along rights. So let's just say you as the founders, and you have your key investors, and the holders of a majority of the shares of the company agree that you've got a great offer to sell the company. You want to take that offer and move forward to sell the company. The buyer wants to buy the whole company. Drag-along rights require everyone, if you hit a trigger point in terms of who that trigger, like a majority of the shareholders plus the founders, for instance, or the founders plus one class of preferred investors and the majority, some trigger, then everybody is pre-agreeing when they become a shareholder in the company that they will sell their shares. They can be forced to sell their shares. So it stops somebody who owns 2% of the company or 5% of the company from holding up the sale of your company if they don't like the deal, and 95% of the company would like to move forward and sell. So another really important right to make sure is in there. And then there is anti-dilution protection. This is protection in the event that you raise money at $5 a share, and then a year and a half later, you have to go out, or 2 years later, and raise money at $2 a share. So it's a down round. So there are different types of anti-dilution protections. There's a full ratchet, which only takes into account the fact that there's a lower price, and all the shares that came in the prior round get adjusted based on that lower price, even if you sold a very small number of shares at the lower price. There's narrow-based weighted average, which takes into account just shares issued and outstanding. So it looks at the number of shares at the lower price against the shares issued and outstanding. Then there's the one that's most favorable to entrepreneurs, which you should be trying to negotiate for, which is broad-based weighted average anti-dilution, which takes into account the total number of shares issued and outstanding on a fully diluted basis. And here you see that term fully diluted basis showing up again. And then you also want to have certain exceptions. There's like a list of standard exceptions that are carved out of this. And you, again, it's in those details. You want to make sure that you've got all the carve outs to triggering these anti-dilution clauses. The next thing we're going to talk about then is the protective provisions. So as we said before, the rights and preferences in the long run are more important than valuation in most instances, and so is these protective provisions. You really want to spend time thinking about them and really understand them in your negotiation. What these do is they provide investors who control less than 50% of the shares or less than 50% of the seats on the board with significant say over certain actions that the company takes. The way they do this is they require the approval of a majority or a supermajority of, just say, the preferred shareholders voting as a separate class. So for instance, if the preferred stockholders only own 20% of the company, there are certain decisions that say, even if the founders who own 80% want to take that action, the language in the agreement and that's built into the different documents that you have may say that to take that action, you have to get approval of the majority of the Series A investors. So those Series A investors only own 20% of the company, but if a majority of them don't agree with the majority holders of the company, and just say it's early on, so it's the founders, they can block that action. The same, you may feel great that you have 3 seats on the board and the investor has 1, and you say, wow, we really control the board. But there may be these types of approvals where it says that you need approval of the board, including the approval of one of the Series A directors. So even though that director is 25% of the board, that board action cannot happen if the Series A director doesn't vote for that action. These are really important. So what are some types of protective provisions that you may come across in a term sheet when you get one from an investor? One is amending the certificate of incorporation and bylaws, if you need to amend the certificate and bylaws, to repurchase or redeem equity, to materially change the nature of the company's business in a pivot, to change the size of the board, to add more directors to the board, or to shrink the board. Here's a big one: to issue new equity or securities convertible into equity that is equal to or superior to the preferred stock. What happens if you want to do another round, you're running out of funding, and you've set it up in a way, even if it's the same class as what you've done with the investors before, you have to get consent. You've kind of put yourself in, depending on the relationship with the investors at the time, a tougher situation. hiring and firing key employees, incurring debt above a designated amount, whether it's convertible debt because you want to do a bridge financing, or just you want to bring in some debt. What is that, and what is that amount, and what are the carve-outs? You decide that you've got an offer, you started your company, someone's wanting to buy it for $30 million. It's a great return for you and the other founders, and you want to sell, but it doesn't give the 10x at that point to the investors who came in a little bit later. If they have a provision that requires their approval for the sale of the company, they may be able to block that sale. And so you may want to have a clause that says, if you give a certain return to the investor over a certain period of time, then you're able to sell without consent. Same thing with the issuance of new security. Maybe if it's a security that's superior to what the investor has, you need their consent. But if it's equal to or below, then it's okay. So there is room for negotiation, but it's important to understand what each of these mean as they show up in your term sheets. Great, so now you've made it through, you've got a term sheet, you've signed the term sheet, the investor signed the term sheet, and you move into due diligence. Due diligence is a process, depending on the complexity and size of the deal, can take a few weeks to a couple of months. Just really depends on how far along the company is. And due diligence is one of those areas where you know it's coming, and you have control over how well prepared you are for it. And if you're not prepared, when the investors are ready to start due diligence, you risk losing the deal because you weren't prepared. You know, what you suddenly, the investors sign the term sheet, they send you a due diligence checklist, and you disappear for 3 weeks to get all your documents in order. You're going to lose that investor. Or you send documents over that are in very bad shape and have a lot of problems that need to be fixed. That may give a lot of concern to the investor, and they may feel if the documents have so many problems and the structure has so many problems already, this is just not a deal worth pursuing. So there's business due diligence, which is kind of looking at your product, looking at your service, your technology, your platform, your customers, things having to do with the business. You're going to work with your accounting firm around financial due diligence in terms of all of your financials. And then a really big piece of this was working with your law firm on the legal due diligence. And there it's kind of broken down into, they're going to be looking at all of your corporate governance and corporate structure. Was your company formed correctly? And did the founders get their stock up front in the right way? And where are you formed? And did you qualify to do business in DC if you're a DC company formed in Delaware? Your principal office is in DC, but you're a Delaware corporation. All those types of questions. Then they're going to spend a lot of time on the cap table and understanding if you've done multiple rounds of funding, your cap table and your ownership has to be rock solid. That is the foundation of the investing in your business. So is it clear that all the shares have been properly issued? Is it clear that there isn't somebody who's been promised shares who was a consultant or a co-founder who's left the business but was never documented properly, and they're going to suddenly show up saying they own 25% of the company? If you've done a convertible note, were those properly issued? And did you do your security filings the way you were supposed to? So all those types of questions will show up. Then there's going to be things all around your people. So your employment documents, your consulting agreements. Did you correctly classify employees as employees and consultants as consultants? Did you have intellectual property rights? So PIIAA agreements, proprietary information and invention assignment agreements. Did you, when people are working for you, have they assigned the intellectual property rights to you of the work that they're doing. They're going to look at all of that and make sure that's there. And if people who were part of the company have left, did they leave before they ever signed those documents? And then you may have to go out and get them to sign and chase them down before the investor will come in. Are all your material agreements properly executed and in place? Do you have trademarks? Do you have patents? What do those look like? What type of regulatory or litigation risk? All these things are things that you can make sure up front have been prepared, are correct. There is room. There are times when companies during their very cash-strapped beginnings do things on their own or copy legal documents from the internet and or reach agreement with people but don't have the money to put proper legal documents around it. And so there is time at the beginning before you get into due diligence to really look at that and have it assessed and correct things that need to be corrected in ways that are correctable, and so that you're ready. And I can't emphasize this enough, just because there are so many times an investor loves the entrepreneurs, the founders, great team, great market, great technology, but the company is a mess from a document point of view and a diligence point of view, and investors just decide to walk away. After you finish diligence, you're going to be negotiating your definitive documents, which are going to be based a lot on the term sheet. If it's an LLC, you're going to have, and you're selling preferred units, it's going to be membership unit purchase agreement and an amended and restated operating agreement. With the Series AA or seed financing, you'll have a stock purchase agreement, an amended and restated stockholder agreement, and an amended and restated certificate. Sometimes the stockholder agreement is broken out the way it's broken out in a Series A preferred. The typical documents for a Series A preferred, you're going to be negotiating a stock purchase agreement, an investor rights, a right of first refusal and co-sale, voting agreement, amended and restated certificate, and then there may be other agreements like indemnification, management rights letter, and sometimes the investor will ask for opinion letters. Then you've got the note purchase agreement in a convertible notes and the convertible promissory notes. Sometimes those are combined into a single document. And then you have the safe, which is just the safe. And you can see again, it's one, that was the one that we spoke about that's kind of very favorable to entrepreneurs. And then you have regulatory compliance. So one of the things to remember is when you raise money from investors, you're going to fall under the securities regulations. And either you're filing a registration statement, you're registering those securities, you have an exemption, or you're not complying with the regulations. So the ability to raise money from investors is regulated by the Securities Act of 1933 and state securities laws. Under Section 5, all issuers must register, which we said before, non-exempt securities, very expensive, very complex process. What most people in private issuances, private sales of the kind that we've been talking about will look for an exemption. Section 4A2 provides that the registration requirements do not apply to transactions by an issuer not involving any public offering. And then there are people have heard of Rule 506 and Regulation D. Often is something that people have heard about if you're in the startup space as an entrepreneur. And what these are is two distinct safe harbors that issuers can rely on to meet the 4A2 private placement exemption. And so you either have Rule 506B, which is in situations where you cannot broadly solicit or generally advertise, and most of the private placement financings are done through 506B. And more recently, you have 506C, where you can broadly solicit and generally advertise, but there you need third-party accredited investor verification. So it's a much stricter level of verification that you work in with accredited investors. And the accredited investor rules and resale restrictions apply to shares issued under Reg D, and you have to file a Form D with the SEC, and then there may be, depending on the state, that the investors from additional filings that may be required within the state in which the investors reside. And that brings us to the end of the presentation. I think there may be a couple of questions, Rachel. Let me just.
We have one question. It's about when setting up a company and you're the sole proprietor, how many stocks should you initially be issued? Does it really matter at that particular part?
Let me just stop the share here. Hold on one second. Hi there. So if it's just a sole proprietorship and you own it yourself, you're often going to set it up as a single member. If you're going to set up a company for yourself and you want to actually set up a legal entity, people will often use a single member LLC. You know, a lot of what we're talking about today is, you know, once you're bringing in other investors.
We got a couple more questions in the chat. Will participants be able to get a copy of the recordings? So from DC Startup Week, we're putting out the recordings post DC Startup Week. So the best thing is to follow our newsletter to get access into that. In terms of the slides, I know if you email info@next.law, maybe Anthony could put that in the chat, you'll be able to get a copy of the slides from there. And I know from Anthony as well as Lisa Friedlander on the Next team, always happy to support and provide that information. So again, to get the slides, email info@next.law, reference DC Startup Week presentation, founder fundamentals on fundraising, and then you'll be able to have access into them. Bruce, if you look at the chat, you'll be able to have that as well. Anthony, thank you so much for a great presentation. I always learn every time when I'm able to go through it and learn more about the different processes and the steps. We appreciate you so much from having the participation of Next as the title sponsor for DC Startup Week. Because of your support, we're able to ensure that this week is completely free for all attendees, which is absolutely amazing to have 4,000 people here, 200 speakers, 100+ events that are completely free. So thank you, Anthony. We really could not do that without the support of Next and partners.
Yeah, we're just to say we're very excited to be able to support DC Startup Week. We think this is one of the most important events of the year for bringing together the DC startup ecosystem. So to you and your team, a big thank you from us.
Thank you so much. We really appreciate that.